Markets just got the news they've been waiting for nearly 6 years after this rare face-to-face meeting between President Trump and Xi Jinping on a tariff rollback, fentanyl chemical crackdowns, rare earth relief, and a big U.S. soybean buys. But does this Dante actually change the deeper U.S.-China split around these AI, chips, supply chains, or is this a one-year ceasefire with a new rule book? We'll talk about all of that today. So what happened was that the U.S. will cut tariffs on China by 10 percentage points, taking the average from that 57% average range down to a new average of 47%. And in return, what we've seen is China will pledge a very strong action against precursor chemicals used to produce fentanyl. Rare earths, China will ease some export controls for 1 year. And this is critical for nearly everything from phones to submarines. Agriculture, China will commit to large U.S. soybean purchases, which will be around 12 million metric tons this season and 25 million tons annually for the next 3 years per Treasury Secretary Scott Bessent. Then some of the other de-escalators, we got a 1 year pause on reciprocal port fees and a pause on some U.S. export restrictions for subsidiaries of already blacklisted entities. Trump described the meeting, and in his words, what he called it is, on this scale of 1 to 10, the meeting went a 12 out of 10. So Trump seems very optimistic and feels pretty good about how everything went. Now, why this matters, we got a few different things from farm relief, manufacturing inputs, price pressures, limitations. And we'll start with farm relief because U.S. soybean farmers get immediate demand after this painful drought they've been in as far as in terms of Chinese purchases. For manufacturing, relaxed rare earth export controls reduce this choke point that's really hammered U.S. manufacturers. For the price pressures, lower average tariffs can cool inflation at the margin, especially for tariff-sensitive goods. And for the limitations, the deal doesn't necessarily resolve strategic decoupling in AI, semiconductors, and these critical tech. So think of it as a tactical reset that we're getting. And then here's where this puts us as far as after the recent deals we've gotten in the recent framework. So China's new average tariff rate will be 47% after that 10% cut. This includes a 10% tariff fentanyl linked line. Where am I at? I'm losing my spot. People's driving past. Yeah, the 10% fentanyl linked line and prior levies. European Union, Japan, South Korea, they'll largely be around this 15% after accords. Japan also pledged a $550 billion investment into the U.S. South Korea with a $350 billion investment. So this would be cash and shipbuilding cooperation. Taiwan, 20% during negotiations. And chips faces separate policy ideas about this one-in-one U.S. production versus imports. For Mexico, what we got is 25% now, 30% threatened, but a 90-day delay to keep talks just going as they're still working out some kinks. And for Canada, they were proposed to rise to 45% from that 35%. USMCA will carve outs. They'll still matter for now for compliant goods, but we could still see a lot of movements regarding that. And then for Vietnam, 20% after deal, 40% on trans-shipped goods, some exemptions via the ASEAN. How would you even say that? It's this pact. But the bottom line here is that the White House is trading tariff pressure for targeted concessions while keeping leverage in this way. So the bigger macro picture. Now, to really understand this deal, we need to really zoom out. We need to kind of take everything with a grain of salt and think about it. Because for decades, trade isn't just about tariffs and soybeans. It's about how money, power, production, how all of those flow across borders. And like I said, for decades, the U.S. has built this global economy powerhouse around cheap imports and dollar dominance. The dollar has been dominating for quite a while. And China, on the other hand, became the world's factory floor by keeping the costs really low out there and U.S. inflation pretty stable. But as this partnership has fractured and changed up, there's tariffs, sanctions, reshoring, we started moving into this new era, one defined by strategic trade, not a free trade kind of deal. And this deal shows that shift in action. It's not about eliminating barriers, it's about managing leverage. So the U.S. cut some tariffs not to return to globalization, but to stabilize supply chains and really buy time for domestic rebuilding. And China's opened up its hand to really, and it's opened its hand slightly on these rare earths, soybeans, mainly to secure breathing room as its economy slows and manufacturing faces these price pressures. So in short, both countries, they're trying to re-engineer globalization without collapsing it in a way. So there's also a deeper layer here, which is the currency dynamic. So every trade agreement affects dollar demand in one way. And when the U.S. cuts tariffs, it reduces costs, which on these imports, which in theory lowers dollar demand abroad. So as global capital rushes back into American assets, energy, tech, treasuries, the US dollar remains the anchor of global finance. And what this does is it creates what economists call the dollar paradox, which is where America can run these large deficits and still attract global investment because the world trusts its system more than anyone else's. They say, yeah, the dollar sucks, they're gonna burn. A lot of people describe it as being the best of the worst, I guess, because they all suck. And that trust, though, depends on stable policy. It's exactly what both the Fed and the White House are trying in very, very different ways to preserve. Now, we're watching a shift from efficiency to resilience, from where cheapest flows to where's safest. The Fed is managing financial stability while trade policy is reshaping and physical supply chains are all moving around. And the U.S. is tightening control over high-tech exports. China is diversifying energy and commodity sources. Allies like Japan and Korea, they're investing hundreds and hundreds of billions of dollars to ensure to secure future partnerships. And this is the new macro environment that we're in, one where trade, tech, monetary policy, they're all geopolitical tools. And yes, this agreement reduces friction, but it's also part of this much larger redesign of the global economy, one that blends cooperation with competition. Because in a way, we're all a team, but we're all like competing in a way. So what we're seeing, it's not just this trade deal that we've gotten today. It's a snapshot of how power is shifting and how it's doing so in real time. We had the largest two economies who aren't ending their rivalry. They're learning how to operate within it, inside of it. And every tariff cut, every soybean shipment, every central bank move fits into this new framework that they're working on right now. So that's what we got real quick. I had to step out for a quick break to come cover everything, y'all. I guess I'll be back tonight. I'll see y'all.